I'm going to cover a couple things and start with really this first topic of buffered ETFs. For those who haven't heard of buffered ETFs, really the way to think about them is that they're designed to really have a defined outcome. So what does that mean? There's two popular uh, goals of buffered ETFs. It's either to find a way to get a better return to the upside in some cases, or they're designed to cushion the downside. Those are two of the most popular types of buffered ETFs. There's a lot out there, but those are the two that typically you see sold or marketed out there on the street. Now, I'm not saying all buffered ETFs are bad, but the problem is with buffered ETFs is that you have to ask yourself, what is the goal? Who are they appropriate for? And why is someone actually going to invest in these besides what I just mentioned? And too often, these things, they're not proven. The problem sometimes with buffered ETFs is that they often fail to achieve not just the upside additional return that they're looking for, or they fail to cushion the downside quite often. And why is that? There's a lot of evidence to support this, but the reason for this is because they're using very poor data, in my opinion. They're using data that's very short term, or they're using very general data. And the problem with buffered ETFs is that the data really doesn't exist for very long because they're all very new and they're very unproven. So a lot of times they may look really cool and seem like a really good idea on paper until they're actually put into practice. And the problem for investors is that while they look to go down this path to maybe get that better return, cushion the downside from maybe not wanting to take a lot of risk, for example, they'd be better off just buying very passive index mutual funds or ETFs on the stock side or owning cash if they're trying to preserve capital to the downside. There's a lot of evidence to support that. So, as you may hear about these more and more, buffered ETFs are continuing to get a lot of press. They're continuing to get a lot of interest out there because, again, they sound really cool when we're trying to maybe pursue a shiny object in the markets or trying to run from risk or when things are fearful in markets too. So that's a little bit about buffered ETFs, in case you were curious. The second topic, which actually has a lot of history, even though people don't realize it, is what's known as direct indexing. That's a term that probably many of you have heard over the last few years, especially because everybody, when I say everybody, I'm talking about big brokerage houses, large advisory firms, both independent, both boutiques. Everyone has used this term and thrown it around as a way to help their clients. Now, for those of us, I know Sarah and I, we worked together many years ago, early in our careers when direct indexing was also kind of known as separately managed accounts or SMAs. That is what is kind of the first word in the industry where we think direct indexing has kind of been, kind of come from, in our opinion. I will say that, in terms of who is it appropriate for, often people with direct indexing or SMA strategies, they're trying to diversify mostly stock exposure, maybe some bond exposure too, but they're trying to pursue other goals like maybe customization. They're trying to maybe do a lot of tax loss harvesting or tax aware investing. And those can be good, but you have to ask yourself, like anything, it sounds cool to see some stocks in your portfolio, but often these things come with some laundry, some dirty laundry, I'll call it. You end up with this portfolio with maybe 500, 600 individual positions with a few shares of all these names that nobody's ever heard of. What also happens, a lot of these are typically sold as a way to maybe tax loss harvest. But the problem is if you understand markets a little bit and believe in capital markets will make you money over time and markets will go up, what ends up happening is that you end up with a lot of positions that have gains that you can't sell. This is a really common thing that a lot of people don't tell investors when they're buying these for the first time. The only way to keep these going for your benefit is if you're constantly adding new cash, for example, in separately managed accounts or direct indexing, right? But a lot of people don't know that, and so they end up with maybe something that they didn't want, and the alternative may have been better just to go in and buy some passive ETFs that are very tax efficient, for example, and maintain diversification a little better, as an example for how investors might think about this differently. So again, these are things that can help diversify. They can help clients maybe complement some other needs they have. But again, usually the easiest solution is going to be better in most cases, and it may not be going down the path of direct indexing, but often right now you're seeing a lot of people buy these and they don't know what they're getting into.